Okay, and then I've got a short screen share. I want to do this one, share, and we'll pull this up. And
Okay.
there you are. I'm going to move this over here so we can get that. And then I have one more thing I need to do. Need that one, and I need my chat.
All right.
All right. There you go. You are ready.
So I just told Frank I had 4 electronic meetings yesterday, one on Zoom, one on Teams, one on UJA, and one on Skype. And every computer is different, but I'm blessed here because Frank's my technical assistant today, so that makes me feel good. So I'm going to speak about the bases and spreads and what it means for marketing strategies and decisions. And let's see, how do I move this forward, Frank?
Just a second. Click here. Now it should work.
Okay. All right. So my plan is to talk about concepts, and I want to embed in this the discussion of intermonth spreads and the impacts of shipping costs, and how do we analyze the bases, and I'll close with what the issues are this coming year at the bases. As a point of departure, I use this slide to describe the fundamental relationships, and I'm sure Fran will speak more about this tomorrow, but I want to put it in perspective for you. On the vertical axis is futures price levels, and the horizontal is the stock use ratio. And just about everyone who does commodity analysis uses something like this. And historically, you can see here, normally for US soybeans, we have a stock use ratio about 5%. Now, 2 years ago in 18-19, we were way out here on the right-hand side at about 24%. That's when USDA baseline came out and said this is going to take 4 or 5 years to get us behind us. And that really put downward pressure on futures down into the $8 range. And then in 1920, we gravitated for varying reasons to about 11%, which is really puts us at about an $8.50 price, which is about where we are right now. Now, yesterday when I listened to Frank's discussion on supply and demand for soybeans, and you'll speak more about this tomorrow, if all of the bad things happen, we end up with a 300 million carryout. That translates to a 7% stock use ratio, which historically puts us to a crop year average futures price of about 970, 980 in that range. So that's kind of a picture as to where fundamentally we look. Now, a lot of things have got to happen about S&D, supply and demands. Frank will talk more about that tomorrow. But also remember on my vertical axis, this is a crop year average futures price. Well, a crop year is 12 months long, so a lot's going to happen within a crop year. But I use this to put in perspective. So today I'm going to talk about the bases, and this is a slide I use in my class. We talk about all of these markets, and you know, historically people only talked about the futures markets as being the only thing that was relevant. Now we've got all these other markets operating as a companion to this. We have the cash markets and rail markets, which impact the basis markets, and the basis markets are influenced by futures. So all of these are highly, highly interdependent. What I'm going to speak about today is this one little component here called the basis price. So when we look at basis, what we want from a hedging perspective is to have a high correlation between cash and futures prices. So on the left side of this diagram, this shows a hypothetical situation where we have a high degree of correlation between cash and futures prices. The idea is that cash and futures are substitutes for each other. If one goes up and down, they'll both go up and down together. So this is a correlation of 0.97, which is a very high correlation. And that would say that hedging is a pretty good thing because the correlation is pretty high. Or another way to think about it is the standard deviation, which in this case is 5 cents, which says there's not very much risk in that particular market scenario. Now here's an alternative case where on the left-hand side, you see cash and futures are not very highly correlated with each other, 0.39. That's a really crappy correlation. And the standard deviation is 0.23. So it's about 5 times as great as the previous slide. Now this is important because when we talk about hedging, and Frank's going to talk about hedging, what we want to have is a high correlation. Now we're kind of blessed in the case of a commodity like soybeans that typically speaking, that correlation is probably about 0.8, which is pretty high. It means there's quite a bit of basis risk, but we still have a pretty viable hedge. Generally, people kind of like to say, if the correlation is less than 0.7, it's a bad hedge and you shouldn't pursue it. So we're pretty comfortable promoting hedging, but I just want to recognize that if I have a correlation of 0.8, that means 20% of the variability in prices are explained by the basis. So basis is really important. And in fact, sometimes in this part of the country, we have as much volatility in the basis as we do in the underlying futures market. And that's not true today because we've had a pretty stable basis the last few months. So we say the basis is impacted by three major components: shipping, storage, and premiums and discounts for quality. I'm going to talk about each of these in my presentation and allude to how they have an impact on it. So this is my world famous diagram that I use to describe the theoretical behavior of the bases. So we have bases on the vertical axis, and on the horizontal axis is time. And the concept is that at harvest time, the basis is really low and it increases in the post-harvest period. And then during the delivery period out here, the basis is equal to the delivery charge at the delivery market. So in the case of soybeans, the delivery market is Chicago, which is shipping certificates, and that delivery charge is about 2.5 to 4 cents. And so that's pretty fixed and pretty constant. And the rate of appreciation in this basis is equal in theory to the change in the reduced cost of storage as we move through time. Now, it's my observation in many years, and particularly in this part of the country, when we're harvesting 3 or 4 crops in a very short period of time, we have a limited storage, limited label space. What typically happens is that at harvest time, the basis is this blue line where it gets pushed down to abnormally low level. And when that happens, and this happens just about always in soybeans, when that happens, all of a sudden, what that says is that cash is really cheap relative to futures. And the best strategy for anybody in the market, farmers, elevators, traders, processors, is to buy as much cash as you can and hedge it in the futures market. We call that a storage hedge. And when that happens, then over time, you know, all the grain's in storage, and in order for it to draw grain out of storage, the basis has got to appreciate at an abnormally high or rapid pace, the slope of that line relative to storage costs, in order to draw grain out of the marketplace. Now, ironically, this is kind of my way to theoretically describe the basis. When I show you the slides in a moment, the basis in North Dakota is exactly what happens. So let me show you a few slides of the empirical basis behavior, and I'll speak firstly to my DTN, which I use in my class, Jamestown, PNW, and Brazil, because they're all important. So people always ask me, where do you get our data? Well, if you were here in our trading room, we got all the data in the world. Any data that exists in soybeans, we have it. We have Thomson Reuters, DTN, Bloomberg, GeoGrain, MyDTN, Trading Technologies, amongst others. And in the case of one of the things that, you know, if you were in the trading room, we'd have you log on to and use these. But I just want to give you a little hint here for on your own. What's transpired is there's been a proliferation of information available to market participants now. And one of the valuable ones that are very low cost is called MyDTN. And you can go and get it yourself. They give it to us for free because we're kind of a beta test version for them. But I think Frame can give you a login, or I think you could subscribe. I think it's only like 20 bucks a month. But they have a lot of information on there. But if on the perspective of the bases, this is a map of the bases yesterday for soybeans. So I have this blowing up. So this is a geographical map of soybean bases. And there's 3 points I want to make. Here's the bases out here in Portland. Here's the bases in the US Gulf. And then you can see the bases in the northern tier counties, typically about -$1, more or less, varies geographically around the space. So if you want to follow this, this is MyDTN. It's a pretty easy and low-cost way to keep track of markets. So, okay, here's a blow up in the case of North Dakota. So I just blew it up is all I did. I always kind of like to look at Jamestown because my students all go to work for Gavilon and a lot of them are out in that area. So you can see they're right at about $1.05 under. We'll come back to that in a blow up historic in a moment. But that's what I'm referring to. So this is the current basis as of yesterday in North Dakota. Another, I guess, program we use in our trading room, I don't know if Ray's going to speak to this tomorrow, it's called GeoGrain. And it's another way to geographically look at the bases and do some analytics as well. So here's the bases in Jamestown. This actually is a class exercise. On the left-hand side shows the bases over all of these crop years from 2010 until current. And that red line, the bolded red line, is the historical average bases across there. First of all, you can see that there's a lot of variability across marketing years. Second thing, you can see that for those lines above that average, typically are years prior to about 2017, where the basis was abnormally high. And in the more recent years, we've had these lower basis values down here. So that's a couple of points to make. On the right-hand side, I show the seasonal behavior of the basis. I'll speak in detail of this at the end of my presentation, but we're real high on seasonality of the basis. This is more true than probably any of the other crops we deal with, and it's driven in part by Brazil. But we have a very notable seasonal trends in the basis of soybeans. I'll come back to this in my conclusion, but you'll see very carefully going into harvest. After July, August, we have a very low basis because of harvest pressures. Then we go into October, November, December. The basis increases by about 40 or 50 cents per bushel, and it stays high through about January, and then it begins to crash. And that's what we're going through now, is in the process of going down like this. And the reason for that is really driven by the bimodal marketplace that we have now because of the dominance of Brazil and the role of the United States. What it basically says is we have a very strong basis market for the period of time where we can be competitive September through about January. And after that, we're starting to encroach upon early harvest in Brazil, and the basis starts falling. So Frank will speak on this to you tomorrow, but what it really tells farmers in soybeans, harvest, store it, look for a short period of storage, and look for selling it when we get into that peak month of basis, typically around December, January. So here's the basis for tinsel around Jamestown, and we're using Kinsel now because Gavilon Jamestown doesn't publish their bids on DTN. So this is just this past year, and there's probably a couple points I want to show to you. So first of all, take a look over here on the left-hand side. So currently, we're at about $1 under. But back here at harvest, that's September, we've reached a low of minus $1.70. So the basis has increased from harvest till current by 70 cents. That's a pretty big increase in the basis. And I think if you look at the other crops around in this region country, spring wheat, corn, I don't believe any of those have this type of an appreciation in the basis. You'll also see here, this is very short-lived, really. Most of the basis appreciation was achieved by the time, this is September 18, this is September 19. Most of the basis appreciation is achieved by the time we get to about December. You can see really since December it's been pretty flat. On the lower part of this chart, I show MACD, and I think Frank spoke about MACD yesterday. It's a valuable technical tool applied to futures to identify turning points. This can be similarly applied to the basis. This is done on, this particular slide is off DTN Profit X, but it's also done on my DTN. And you can see the turning points that are identified. Here we got a turning point identified right here in September. It says it's the bottom of the market right there where it gives a buy signal. Then it appreciates and reaches another turning point here in November, which says that the basis is starting to fall. And right now, we've been appreciating for about the last 3 or 4 weeks, but we're at a very crucial time right now where they're beginning to cross, which is beginning to suggest that we're probably, in the case of Kinsel, reaching a peak. There's the same one in air. They're big supporters of our program here, and I like to show their slide, but they're big shippers of soybeans. And you can see the same sort of story here. The lot of difference across different marketing years. The 2020 is this yellow line, so they're typically about $1 under, much less than the longer term average, which is this red line. And you can see that that red line reaches a peak here in July and then begins falling through to about October. Here's today's look at the bases at air. So let's take a look here. So this would be September 18, where we fell to $1.60 under, and in the post-harvest period, it increased to about minus $1.05, so it increased 55 cents. And this year we reached a harvest time low also in September at about minus $1.40, and it's increased now to about minus 95. So it's had about a 50-cent increase. So look at those seasonal lows and the rapid post-harvest appreciation. And you can see here right now, this behaves a little different than Kinsel. Right now, it's pointing to a little bit of a bullish signal on the bases. I don't know exactly the reason for that, but it's certainly approaching a top. Whether it continues going up or not will remain to be seen. So our markets are completely dependent on the PNW, Pacific Northwest, for exports. So this is a slide of the basis values at the Pacific Northwest, same story to story. All of these are different market years. The solid red line is the longer term average. We like to say that's the normal basis behavior. You can see that peaks out in about August, September, and then starts sliding. These lower lines down here are the more recent crop years, 2018, 19, and so forth. Now, we've analyzed this very extensively, and if you're interested, send me a note. This is sponsored by the North Dakota Soybean Council, but this is a paper by Bullock and Wilson talking about factors impacting the PNW basis. There's two factors. You can talk about everything in the world, two factors that drive this. What is the Brazilian export basis? The other is China imports. So I'll come back to my conclusion. If we want to get that basis back up to a high level, something's got to happen to China imports and something's got to happen to the Brazilian export basis. Okay, so this is, so I'm going to skip a few of my slides. I'm sure you get my slide deck. I'm not going to speak to every one of these slides, but I have to emphasize to you the importance of the Brazilian basis. Ultimately, they're a bigger exporter than we are now. They're really the dominant export. And there's a direct relationship now between the PNW bases and the Brazilian bases. I think in the future, anytime anyone's going to talk about soybean bases, they have to talk about the Brazilian bases. And I'm going to elaborate on this at length in the rest of my slides. So this red on the left-hand side is the longer-term average. You can see that they're at seasonal lows from January through May. And then as they go into that July-August period, they go to seasonal highs in August and September. So what does that mean? It's exactly obverse of the bases that we have. On the right-hand side is the seasonal behavior. You can see that they go into declining basis mode into May and June, and then increase very rapidly. Now, how low they go depends upon a lot of things. Harvest, how fast are they harvesting, and how high they go really depends on how much of a crop they have left to carry over. But this is a notable increase in that basis, and that's what drives our basis up in that period of time into August through December, more or less. Now, how high it goes and where they reach peaks seasonally is yet to be determined, but I think it's driven a lot by the size of their crop and their export capacity. It used to be that they could export about 5 million tons a month, which is 60 million tons a year, which is less than they export to China. But recently, in April of this year, they've expanded their export capacity, and there's an idea, of course, there's lots of other things going on, that they're going to be able to export continually through the August, September, October period. And in April, they're expected to be exporting 13 million tons in 1 month. That's going to probably shift the behavior of this basis in the coming years. So we got this word China tariffs, and I'll just show 2 slides on it. You're all very familiar with it. But you know, the word 25% is that from about July 18 until February, there's a tariff on imports from the United States at 25%, which is about $1.90 a bushel. That's now been relaxed, but I want to illustrate the impacts of this. So these lines up, this is the basis from 2018 until current, and these lines at the bottom are the bases at Brazil going to China. So that's delivered China. So that's Brazilian bases delivered China, and the top lines are US P&W, US Gulf delivered China. So you can see back over here, we're pretty competitive with each other, but now in these latter months, we got to be we use the word bifurcated because of the dual nature of the marketplace. Now, if we look at it today, and I think this goes through early February when we were getting ready for the March seminar, this shows a longer term view of this. So you can see, so this gray line and yellow line are Brazilian bases, one going through the canal, one going through the Cape of Good Hope delivered China. So you can see back here in the area of 15, 16, we were very, very competitive with each other. Sometimes we're cheaper, sometimes they're cheaper. There's a high degree of seasonality in it, as we talked about earlier. Then you can see the effect of the tariff war here, where the US values went to a significant premium relative to Brazil delivered China. And now in the recent few months, a few weeks, you'll see that our values are near equal to each other delivered China as a result of relaxing the 25% tariff. I'll show this in detail later in my presentation today. I just want to emphasize how important the Brazilian basis is for us. So this is the current basis, FOB, and that means loaded on a vessel. The green line is at the US Gulf. Yellow line is at the P&W, and the blue line is Brazil. This comes from a new data source we just put in our trading room called AgriSenses, and it's the only place I'm aware of that publishes export FOB basis values for these competitors. And it's quite useful. I use it in my class a lot. But you can see here back in September 18, where Brazilian values were much higher than the United States. And we go down into the recent time period. So this would have been yesterday. This is the value at the P&W, yellow. The blue one is the value at Brazil. And the green one is the value at the US Gulf. Okay, so today, I want to show you two slides here as we kind of tee up today's marketplace. These are from ADM. In part, they're from ADM because they're friends of ours. They hire a lot of our students. Also, they're probably the biggest buyer of soybeans, at least in this country, if not the world, I guess, between their domestic crushing and their exports. But these are very instructive. I wasn't intending to show you two of them, but in January, the top one is January. And so that was, I guess, when I was presenting last. And I highlight two numbers here that I want you to pay attention to. So these are in January. So this is the bases at the P&W, and this is the bases at St. Louis. Those are the two markets we have to compete in. So we're looking in January at 82 over and 26 over, and looking at new crop at that time at 80 over the P&W. But take a look here, they put out bids for every month from February until October. So those are bids to buy delivered Portland. We call it track Portland price. So I think that's pretty important that at that time in January, they were putting out bids to buy for every single month. Okay, the lower part of this chart is today or yesterday. Okay, so there's a couple notable differences. Take a look here. They don't have a bid for spot until new crop. They don't have any offers out for spot until new crop. Now this is Kalama, Washington. It's the biggest exporter in Pacific Northwest. I've not spoken to them. I don't know the reason why. My guess would be they would say, well, we don't see farmers selling. We don't see anybody buying because Brazil's dominating the market until new crop. So what they're effectively saying by not having a bid there is there's really no market that we can sell to until we're looking at new crop. So, but however, you'll take a look at their new crop bid went up from plus 80 to plus 90. So they're a little more, or the market is a little more optimistic for a number of reasons I'll talk about later about new crop sales via the P&W. So that's pretty instructive. These are things we follow here. Okay, I want to make a few comments about intermonth spreads, and then I'll stop for a few questions if you have. We'll take a couple-minute break. So intermonth spreads are a pretty important aspect of grain marketing and of the bases, and Frayne will speak about these tomorrow because it ultimately affects your decision to store. So in commodity markets, we talk about normal markets and inverted markets. Normal markets are what we think is normally expected to occur, and particularly important shown in this chart, it shows a positive price differential amongst different months. So you see your March, May, July, $8, $8.20, $8.35. So the total spread between those months is 35 cents. You can interpret that as your gross revenue that you can earn from the futures market from storage. We call it normally because that's what we normally expect to occur, meaning normally that's what would happen. Now in reality, we also have something called an inverted market. And I hate to say it, but since I've started my career, I would guess prior to 2008, we were probably a normal market, probably 80% of the time. Now, my guess would be we're a normal market 50% of the time and inverted 50% of the time. But it's very important to understand these and the signals that it gives to you, particularly as growers. So you can see in this inverted market, we have a negative price differential between successive futures months. And what that really means is don't store. It says there's a short-term storage for some reason. So there's a nearby demand that's going to pay a premium relative to the deferred. So this is a negative 65. And if you think about that as a return to storage, no one's going to store to earn minus 65 cents. Well, there's a pretty elaborate theory behind this. I won't bog you down on this, but I think it's maybe give you a little picture you can bolt in your mind. And the theory behind this goes with this figure that I'm looking here at the top. And the vertical axis is the price of storage. That's that price spread I just showed you on the table. So on the top part is a positive price spread, and the bottom part is a negative price spread. And then the horizontal axis is a level of stocks normally measured as a stocks to use ratio. So in my university class, I have students collect data on historical stock use ratio and price spreads and plot out exactly this figure. It's a very good relationship. And this black bolded line is our theoretical supply of storage. And what it says is that we have very high stock use, that price spread will become very large. But as the stock use ratio goes down, it's flat for a long period, and then it becomes lower, and then eventually becomes negative. And that's what we call an inverted market. Now, in today's market, in the last few years, here's what's transpired. Probably about 16, 17, we had a stock use ratio here, where we're just on the cusp of having a positive return to storage. Then in 18, 19, we put the stock use ratio way over here at about 0.24, which resulted in a very high price of storage. So the best business in the world was storing soybeans someplace in the United States. And then in the last couple of years, that stock use ratio has moved leftwardly. And so last year, we're probably about here. But as we go down to, if Frayne is right, to about 7% this coming year, we're down here where this is becoming lesser of a full carrying charge market. Okay, so you don't have to memorize all this, but just remember this little picture, because this is what explains and causes that price spreads to change. So today, or Monday, these are the marketplace you look at. So these are the futures price levels. You can see this as a normal market. And those price differences are shown here. And cumulatively here, they're shown in this third column. And then I'm using 5 cents per bushel per month for storage. Frayne can speak upon that differently tomorrow. But I always use this to teach about what can we learn from the market about is it reasonable to store the commodity or not? Our revenue from the futures market is this price spread. Our cost from storage of 5 cents per month is included in this calculation. What it shows today or Monday, it was a negative return to storage. So if you're making a storage decision today, you would choose not to store because it would not be a profitable decision. And I'm particularly looking at these new crop months because Frayne tells me most of you have already sold old crop, so we're not worried about that very much. But I'm particularly looking at these new crop months, so take a look there. August, September, November. That's only a 5-cent spread between 3 months. And what that says is just out of the box, it's not reasonable to consider storage at harvest time. We might storage for basis reasons or logistical reasons, but one should not be envisioning a longer-term storage path commencing from new crop harvest. Fran will speak more on that tomorrow. Okay. So I want to make a few comments on logistics, and then we'll take a break. So this is the second side of this. As we say, the basis is impacted by the price, the cost of time, as well as space or geography. So I think maybe just briefly, you have to understand that in commodities grown in this part of the country, we're dominated by rail. Rails have tariff rates and they have car markets. And I'll just make a few comments on each one of these. This shows the behavior of car market values on the right-hand side. And you can see that we have a lot of volatility. On the top part, it's the secondary car market values. And on the bottom part, it's the cars late. This goes from 24 until current. And you can see that sometimes we have negative secondary car market values. Sometimes we have very large positive secondary car market values. I'll show current values in just a moment, but these are quite volatile. And as I will point out to you, these have an impact on the P&W basis and at the origin basis, and they ultimately impact marketing strategies. So in concept, every railroad in America has something called a primary market, where they allocate off shuttle trains for up to 12 to 36 months forward. Then whoever buys those trains, they're obligated to ship by those trains. And should they want more or need less, they can buy or sell them in what is commonly come to be called the secondary market. So when we talk about the secondary market, it's the market where somebody sells if they have surplus cars, where somebody buys if they're short of cars. So let me give you just an example. Here's an example of a primary market. This is on BNSF. So this would be 2016, where in the top part, they're going to make a sale for shipments during these time periods. These are by code. These are first period, middle period, and last period of the month. On the bottom part here, it shows that they received bids ranging from $1 to $77,000 for the train. And this shows the number of bid by how much they bid. So that would be the results of the primary market auction. And this bidder here who bid $77,000 would get the shuttle train. And then we go to the secondary market. So this may be ADM, or it might be Berthold, it might be CHS. And I've come to realize now that a number of the larger interior shuttle elevators now are buying primary instruments themselves. And then going through time, they may decide that they have a bigger crop and farmers are selling more, so they got to buy more. So buy more soybeans, so they have to buy more freight. Or they may discover people aren't selling, so they got to sell freight. And that happens in the secondary market. This is operated through brokers primarily. There's a number of them. The one we subscribe to is Trade West. This is from August 17. I want to highlight it to you because it would be what I would say is a fairly typical secondary market structure. So you can see these are different periods forward from, this is August until November. These are the bids of people willing to buy and the offers people willing to sell. So you can see in nearby, that is a negative market value, okay? And this is really important for you in soybeans because you're harvesting in about this period and you gotta be looking at that. So we got negative secondary market values, but as you go into October, and here, this period here would be October, November, December, that range is $1,300 to $1,600, excuse me. $1,600 a car. So from the beginning of our harvest period, soybeans, until peak month in November, because of corn, the price of the secondary market value goes up $1,000 a car. That's a very important thing. Here's February 19th. This would be an inverted market. Take a look here in February. We have high values, $700 to $2,000 a car. Somebody over your $2,000 a car, what that probably means is he's short freight. He or she is short freight and they need it. So they're willing to pay a lot of money for it. But we call it inverted because in the nearby, there's a premium, and then in the deferred months, it's a sharp discount, okay? Same sort of logic. Here are yesterday's values. So, and I want to highlight these to you because what's transpired in the last 2 or 3 years, for 100 reasons, we have very deflated secondary market values. We've seen lower values now than we've ever seen before. That continues today. I guess the reason for that is farmers are storing instead of selling. We don't have a lot of export sales. And so all of these reasons, so today's market, you can take a look here into April, May, June, all of these secondary values are very close to zero. Now, technically in the railroad, in the BNSF system, they have a cancellation penalty of $200 a car. So if you bought a primary instrument, you decide to sell it, and you decide you don't need it, you can cancel it at $200 a car, or you can sell it in the secondary market. So you can see here, all of these values are greater than minus 200. We did see a period of time last winter where these values were as low as minus $800 a car. What that meant is somebody decided they didn't want to cancel the train because they wanted to have the shuttle available for future months, but they would sell a nearby shipping period. But of instruction for you, and I want to take a look here, as we look over on the right-hand side, this period of time, OND, October, November, December, our gut month for selling soybeans is no bids and no offers. There's some indications of maybe a value of $150 a car in October, November, December, and looking in April, May of next year is minus $200. Now remember the previous slide, that was typically about $1,000 a car. So historically, during October, November, December, the average secondary market value is $800 a car. Today, that value is about $150 a car. So from a freight perspective, this is very attractive for you as growers. So here's the secondary market values. These are in dollars per bushel from 2015 until current. I have students who do their thesis on this stuff all the time. So you can see the peaks we had in 17, the peaks we had in 19, and then in early 2020, we went to a very sharp discount here. It was about minus $800 a car. More recently, we've gone upwards. And I'm sure the reason for that is the anticipation of Chinese purchases and then the realization of a few Brazilian logistical problems. A source of information, you know, I get all this information because of what I do and where my students work, but a source of information where this is available is at this website here. They publish this information regularly, and it comes from the same original source of data. They just manipulate it a little bit. So if you want to follow it carefully, this is the way you can do it.
So Bill,
yes,
there's one question that popped up. What does the 1/2 mean in the second rail market, secondary rail market?
So that would be a package. If someone's saying, I'm going to sell a train for first half or last half. So this would be for first half of the month. Were there other questions? All right. So this is what CHS does. They don't do it now. I think they've changed the way they're doing this. But CHS and the other companies, ADM, Gavilan, Bunge, would take positions in the primary market, and they would offer to their suppliers secondary cars. And they might do something like, we will buy your soybeans, we'll give you cars. And here's the value of the cars. What they're really saying is, we bought a lot of cars ahead, we don't need them, we could sell them if you want to. And so this is September 17th, and you can see here, looking in October from September, they were asking a premium of $1,100 a car for October. That'd be for first period, middle period, and last period. So a very high premium in October, corn harvest, and then it goes to zero, and then goes to negative. That'd be very, very typical. Okay, so I'll just show you a couple slides and we stop for break. Okay, so this is a slide. I want to impress upon you that there's 3 or 4 variables that are really critical. The bases at the P&W, the bases that are interior North Dakota origins, the secondary market values, and something called velocity. So in this graph shows the blue bar is the secondary market values. You can see the peaks here in 2013, 14. And then this gray line is called velocity. That's measured off the right-hand axis. That's how many trip turns per month that the railroad gets. It's, in a sense, their measure of productivity. On average, it's historically 2.7. Sometimes it's higher than that, sometimes it's less than that. But in our statistical analysis, the most important factor impacting secondary market values is velocity. Think about it this way. You're ADM and you buy primary instruments thinking you're going to get 3 trips a month, and you only get 2 trips a month. And if you sold all that grain, that means you're short freight for 1/3 of your position. So you've got to go in the market to buy it away from somebody else, or vice versa. You're ADM and you buy thinking you're going to get 3 trips a month and you get 4. That means you got 25% more cars than you need, so you're going to sell them. So this velocity has a huge impact on secondary market values. Secondary market values have a huge impact on the export basis. That's the logic. So you can see here in 2013-14, that secondary market value, the velocity of this gray line went down to about 2 compared to an average of about 3. And that's what forced these secondary market values to very high levels and forced this basis to very low levels. And then that's happened periodically over time. Now, fortunately today, and the last maybe 2 years from 2018, they've been above average velocity, which has forced secondary market values to below average values. This shows the correlation between these crucial values. So this is a highlight down below. This is the correlation between the secondary market value and the basis of P&W is 0.5. And then this is a correlation between the basis of Jamestown and the secondary market value, minus 0.19. So what this says is that when secondary market values go up, it has a negative impact on the basis in Jamestown and a larger impact on the larger positive impact on the bases at Pacific Northwest. Okay.
We did have one question.
Yes, go ahead.
Okay, so it's over here. I just got to move this for 1 second. So the question is, does the primary and secondary rail have to be in the same area for the primary purchase?
Yeah, the answer to so I'll repeat that. Does the primary and secondary rail have to be in the same geographic area of the primary purchase? The answer is no. Historically, and I was very involved in development of this, historically the railroad, the BN in particular, had what were called corridors. They had market corridors, which were geographic and commodity specific. So if you sold a secondary instrument, it had to be in the same corridor. And if you took it out of that corridor, there was a switching penalty. And that was abandoned about 5 years ago. So now they're geographically and commodity generic. I think that should answer that question. Okay, so let me just summarize this and then we'll take a 5-minute break. Okay, so our marketplace has changed very radically. This, I don't want to say, I hate to say it, but the commodity market, particularly the basis market, has become very intertwined with our logistical market, whether it be barges in the east or rail in the west. And these freight instruments have a significant impact, both on the export basis and on the interior basis. And that has an important influence on how you craft as a grower your marketing strategy. I'll come back and give you some solid advice on that later in my presentation today. Okay, so what I'd like to do is take a 3-minute break. I'll come back and answer questions of what I just covered. And then what I want to do is show you how we analyze the bases and how you can be analyzing the bases. Is that okay? So just take a 3-minute break. Okay, let's get rolling again. If there's any questions, either send me a note by chat, or I guess you can call in or speak to your microphone as well. Yeah, so you've unmuted it. So if you got it, any questions? So it must be pretty boring, or?
Or you covered it.
Okay, so here's where I'm headed now. I'm going to talk about how we analyze the basis market, give you some tools that are important to you. And then after that, with or without a break, then I'm going to take a look at the new crop in particular and the impact of China, Brazil, and the seasonality looking into the coming new crop. So I'll give you some specific direction there. Okay, so all right, so probably some things I want to show you. The source of information we use in our teaching here, and I think Frame probably uses this as well, is we use MyDTN. We use a package called GeoGrain, and we use DTN Profit X. I'll bring to your attention, you know, this availability of information has proliferated substantially in the last 5 years. And we're not using Thomson Reuters in this particular session, but in my university class now, all of this stuff is on Thomson Reuters. And now they're even publishing secondary market values as well as barge rates. And I have a student doing his thesis on artificial intelligence, machine learning. And he uses a program which extracts the data directly from Thomson Reuters instead of a spreadsheet. It's pretty amazing how rapidly this is changing. So I'm sure in the coming years, this will only give greater challenges and opportunities for all of us. But things I want to show you today are mapping and then projections, how we make projections using seasonal indexes and MACD. And then I want to talk about spatial competition, particularly regarding PNW, St. Louis, and Brazil. So one of the packages we use is called GeoGrain. I think sometimes it's called Grain Hedge, and I don't, tomorrow you can show them the link to that. I'm not covering that in this presentation, but it's kind of a nice story in that this shows one of their slides. I remember I was on the Grain Exchange Board of Directors, and I think it was back in the early 1990s, we created an index and created a contract with DTN that we would use their country prices to create an index. And part of the agreement was it couldn't be used for any other purpose. So then as all this information technology proliferated, these people out in Bozeman created a company called GeoGrain or Grain Hedge. And what they do is they call approximately, I'm sure this has changed, they call 1,700 elevators every day. And by the end of the day, they all have it encoded on the computer on zip codes. And you, in your farm in Max, North Dakota, can go on, plug in your zip code, and you can see all your surrounding bases, just like I have here. Another click of a button, you can plot it out. You can plot it out by historical averages, plot it out by competing elevators. You can take it a step further and plug in your trucking costs and find out where's your optimal selling strategy. So that's how quickly this has changed. Of course, now many companies are using this, and their source of data is this company, Grain Hedge. So this is their.
So we did have one question that came in.
Yep.
So it's, referring to the slide that had CHS for 12 months on the primary rail, is there a point of loading for every train bought at a time? Maybe you want to.
So I wonder if, do you think that's a geographic point? Yeah. Okay, so back to this. So just on this particular
question.
Yeah, I'll repeat the question. This is 12 months of the primary market. Is there a point of loading for every train bought at a time of purchase? So first of all, this is CHS's slide. They don't put this out anymore. I had students who used to run that. They lost a bunch of money, or there were some problems, which I can't speak to, and there's new people in charge, and they don't distribute this. I think it was a mistake because it provides transparency about what their interpretation of the market is. And so the question is there a geographic point? And the answer is no. Technically, the way it operates is when you buy a primary instrument, you load it at your origin, ship it to the destination, And within 12, I think it's within 12 hours, you have to declare the next origin. So maybe I ship it from Argyle to the P&W, and 12 hours before it finishes unloading at P&W, I have to indicate my next origin. Maybe that's going to be air. Or maybe I sell it in the secondary market to Gavilan and they want it in Jamestown. But I have to declare the origin concurrent with the unloading of the shuttle, is the answer to the question. The reason for that is the railroad wants to give a lot of flexibility to shippers, which ultimately enhances the value of the instrument. Okay, so this is GeoGrain. I'll move on from that. This is my DTN. I discussed that last time. It's a easily accessible, very low-cost way to get access to geographic basis values. Now, people always ask me when I teach this, how do you forecast? What do you do, or what do you recommend? Well, we're in academia, so we create lots of elaborate forecasting tools that nobody can understand other than other academics. So I'm not going to burden you with that, but I'll give you two tools that I think are pretty practical, and this is what I promote. And one of those regarding seasonality is using some type of turning point technical tool. I promote the use of MACD, or secondly, using seasonal projections. I do this because these are easily accessible. Both of these are available on my DTN or GTN Profit X. But what you're looking at in the basis is you're looking for turning points. Ultimately, you know the basis is falling. You want to find out, are we at the bottom yet? You know, or you know the basis is increasing, like I showed you earlier. You kind of want to know, am I at the top yet? So what we're really looking at is turning points. So to that, so this would be, Frank covered these yesterday, I think, in technical analysis, but this would be a long-term chart of something. I don't know what it would be, but it'd be a 5-day moving average and a 20-day moving average. And the concept is when the short term crosses the long term, it suggests that there's a change in direction. Now, ironically, I got to tell you this story. When I first started this trading room, I had a young man from Norway in my class, and he was very smart and really good at spreadsheets. And I said, can you create an MACD on a spreadsheet? So he spent a couple months figuring it out and got a very elaborate spreadsheet, and I used it in my class for several years teaching. Next thing I know, DTN's got it on their system. So that's what's shown on the bottom part of this chart. So this is what I showed you earlier. This is Kensal around Jamestown. And the bottom here is the MACD. So it's a turning point tool that is used for futures market, but it can be similarly applied to the basis market. And in fact, it's probably more as important in the basis market. And you can see that anytime the blue line crosses a red line, that suggests that there's a turning point. And then now in DTN, you can indicate it to put in a signal. Is it a buy signal or a sell signal? So you can see here, we got a big sell signal here in October, November, and getting down here to about early February, we got a buy signal. And we've increased just slightly, and now it's about to cross where that distribution is equal to 0, which is probably saying, you know, from a shorter term perspective, we're probably at a top. But you better watch it in the next couple of days. Here's the same one on air, North Dakota, as of yesterday. And just looking at this, you can see these big signals which were detected back here, right here again. And now looking forward from February, March, we've been increasing here since early March, and we're continuing to increase. And they suggest here that you should be buying or staying long because of the continued increase, but they're getting very close to each other. So if you're following this particular market, number one, you notice that Kensal is different than air, probably to be expected, but it's probably on the verge of getting a little toppy, and it wouldn't be surprised me in the next 1 or 2 days, we're going to get a sell signal, meaning we're at the top of the basis market. So MACD is a pretty easy tool now. Actually, it does it automatically on my DTN. So it's a useful tool. If you want to do it in a spreadsheet, send me a note. I'll send you a spreadsheet that does exactly the same thing. The other thing we promote is seasonal indexes and the seasonal behavior of the bases. And now the concept here is that most people in my profession will say that, you know, the futures markets are pretty efficient. So it's pretty hard to out-project the futures market. We joke a little bit about it, but it's pretty hard to out-project the futures market. But the basis has some characteristics which means that it can be projected. And most important is a seasonal characterization of that basis. That's particularly true in seasonally produced crops, such as our annual crops produced in this part of the country, and particularly true in soybeans because of the impacts of Brazil. So we derive formally an index. So here, I showed this to you earlier. It's probably a takeaway point, whether, you know, you probably, I don't want to say it's the most important thing they learn here, Frayne, but because I'm sure whatever Frayne says is probably more important. But if you take something away from me, whether you use the tools Frayne talks about tomorrow or not, this is a long-term average seasonal behavior of the bases in Jamestown. But I suspect it's typically true throughout North Dakota. What it says is between about March and August, we have a pretty significant decrease. Excuse me. The reason for that is Brazilian harvest, and they're selling their brains out. And number two, the approaching harvest of the northern tier soybeans in America. And on average, that basis falls about 20 cents, which means that probably 8 years out of 10, we see that type of behavior. And we have a substantial seasonal appreciation from August to about December. Sometimes it carries over to January, not always. Technically, the peak is December, but I want to say sometimes it carries over into January. And that seasonal appreciation is about 40 cents. So in a sense, between now and December, there's probably going to be a 60-cent move in the basis. So this is pretty substantial. This is more true than the other commodities that at least I analyze in this part of the country, and more true than I've seen elsewhere in the country, because they're lesser influenced by the freezing logistical system in Brazil. And the only other place I know of which has such extreme seasonal behavior of the bases is Russia and Ukraine. Isn't that ironic? So we derive something called an index. And using the data I just showed you, deriving it over this period of time, 2010 to last year, this is the index I showed you. So the behavior is exactly the same. Down here below, you can see what this shows is that the interpretation of this, let's say, take a look here at April, says that in April, on average, the basis is 89% of the crop year average. So if you say the crop year average is going to be $1, that means in April to be 89 cents. And then it increases, reaches a seasonal low in July, August at 61%. 1% of the crop year average. That's the seasonal low. And then it goes up and reaches a peak, you'll see here, in December at 120, January at 116. So you can use that to generate projections about what the bases will be in the future, deriving these as percentage changes. So in one of the studies Dr. Bullock and I recently did, we looked at the seasonal behavior of the bases of Brazil, Gulf, and PNW, and these are for the PNW. But I want to just highlight to you that the seasonality doesn't behave exactly the same every year. Sometimes people like Frayne will talk about long crops have short tails, short crops have long tails. We call that seasonal analogs. And what this shows is the PNW, and up above shows the most common, the years that are most common are these years here, 24 to 2015, and that's P1, which is the amber colored line. So you can see that that has a seasonal low in June, July, increases into September, and reaches a peak in January and then falls off. But we did have a peculiar year here in 2014. That's when we had low velocity in rail in the northern part of this country. And with peculiar years here in 07, 11, and 13. Okay, so in a study we just recently completed for the Soybean Council, we looked at what are the factors that impact these basis values at the US Gulf and PNW. And a couple of takeaway points I want to make sure you understand. The most important factor impacting the export basis value is the basis of Brazil. And we're doing another study on that right now. Brazil is clearly dominating this market from a basis behavior perspective. And you really can't talk anymore about the basis in US export ports unless you're also talking about the basis at Brazil. The second one is the level of Chinese imports. And so statistically, the second most important factor impacting the basis at export points is the level of Chinese imports. So when we have those real strong imports there in that period of time, 14 through 18, 17, that is what created that above average basis level. The reason why we have abnormally low basis today is because of the lack of export sales. So in my class, I have my students go back and identify, and we do this in wheat and corn, I've never done it in soybeans, but identify the crop years that have seasonal lows. So now Brock Associates did this, and this is what they did on soybeans. So they went every crop year by month from 1970 until current. And what they showed is 30% of the time, the seasonal lows occur in October. 28% of the time they occur in August. And as we go into those other months, hardly ever are we at seasonal lows. So what that really means is, you know, seasonal lows, August, September, October, with a little bit of judgment, and then we go into the post-harvest appreciation of prices. So people always say to me, we say seasonal lows at harvest time. They always say to me, well, what do you mean harvest time? Harvest begins in August and goes till November. We analyzed this a number of years ago and using exactly this data and found that the seasonal lows typically occur when we're 60% done harvest. So when the US as a country is 60% done harvest, then that's the most likely time period for seasonal lows in the basis. Maybe I'll just stop for a moment if there's questions, and then otherwise I'll just continue on and look at this current market year and spatial competition. But is there any questions on, maybe summarize what I just showed you? You know, it's really important for you to, in making good marketing decisions, have an idea of the basis. We think it's important to look at it geographically, and then from a seasonal perspective or a shorter term turning point perspective. Trying to put these all into perspective tomorrow about overall marketing strategy. But is there any questions at this moment? Either you could, I guess you could speak to it.
Either. So you can either unmute, or if you want to type something in the chat box and or in that group chat area, let me know. We'll try and answer it.
Can you hear me okay?
Yep. Yes.
Okay, so Brazil has a more corporate farming environment that's owned, or CHSs and ADMs and different companies like that pay for the input costs. Does that have any tie to how the basis works because of a corporate, more of a corporate farming versus a so-called family farming environment that we have in the United States? Do they have any more control because of that?
Yeah, good question. Let me take a whack at that and see if I could elaborate on it. Frank can maybe speak on it more tomorrow. So generally speaking, there's larger farms in Brazil. It doesn't necessarily mean they're corporately owned. There's a few large agro holdings like exist in Russia and Ukraine. But to my knowledge, I don't believe ADM, CHS, and others are involved in farming. Now, they are more corporate, using the word that you just described, and of significance to that, which might have an impact in this. It's a very common practice for the large multinational companies. I don't know CHS, I think not CHS, but I'm quite confident on Bunge and ADM. It's very common for them to buy bundles of inputs and barter for bundles of output. And it's common for a significant amount of the purchasing that's made there where I'm Bungie, I'm going to provide you fertilizer, seed, and chemicals, and you provide me a ratio of bags of soybeans. So that's pretty common. And I think it has an impact on the basis because my guess would be that the buyer of those soybeans, they don't want it to go into remote storage that they don't control. They're going to want to move it as fast as possible, as technically possible. So we don't have this long multi-year storage by independent family farmers. I think driven by that contracting mechanism. That would be my interpretation of that. Is there other questions at this time? Okay, so then let me carry on. What I want to talk about now is spatial competition for northern soybeans, and then I have a look at the current market year. So I discussed this slide earlier, and these are two magical numbers for me up here. This is the basis of the P&W and the basis at St. Louis, looking at new crop, because Frank told me you already sold old crops, so we don't have to worry about that too much. So take a look at a couple things here. So this is the St. Louis basis. So this is the alternative to the P&W, and this is where your soybeans would go. And probably a couple points. This goes from 2018 until current as of yesterday. A couple points here. Take a look here at that basis. It's September, seasonal low at about 40 under, and now at 30 over. That's a 70-cent increase in the basis. And I think if you went back here to September in 18 until post-harvest, we saw a similar large increase. So that seasonal appreciation in the basis is very, very important. Here's at the P&W. This goes back again 2018 until current. And there's some gaps here because there were no bids during that time period. And that was when we were going through the trade war and nobody wanted to buy it because they didn't know where they could sell. But take a look at this seasonal behavior here. In 2019 September, the basis went to a low of 20 over and went to a peak of $1 over. Now we're at about 90 over. So that's a huge appreciation in the basis, about 75 cents. So I just have to emphasize to you the importance of this short-term rapid appreciation of the basis for soybeans in this part of the country. I'm going to come back to these in some calculations I'll show you in a moment. So this shows today's values for delivery to St. Louis or P&W. So say if you're from Jamestown, North Dakota, and this is spot, so this would be spot today or yesterday, and then this would be new crop 2020. And so there's a couple of values I put in place here. These are the track values from the last two slides I just showed you. So that's delivered to their port. These are the freight costs to those destinations, actual freight costs. This is the net price Jamestown. This is the current Jamestown bid. So this is the net return to a Jamestown elevator. You'll make 57 cents going to P&W, 25 to St. Louis. Where's it going to go? P&W. Okay. If we look at the same thing on the right-hand side, that's new crop, same thing. Where's it going to go? P&W. So what does this say? And I have to emphasize it to you, and I don't know if Stephanie's still on the line or not, but I'm on the North Dakota Soybean Council board, and we listen to all this stuff from the smart people in Washington. Don't worry about China, find other markets. Well, in the case of soybeans, other markets are south and east instead of west. So if we're going to go to other markets, we got to go to St. Louis. That means we got to go from Jamestown through Minnesota, through Iowa, through the barge system to get someplace where we could compete in an offshore market in North Africa. And it just shows that it's not economical to go there. Since I've been following this since 2016, very detailed, it's never economical to go there. And you can see here the St. Louis market, which would be for the US Gulf, is easily 25 cents out of the market. And I think that's just about sustainably the case. So that's why the P&W is our market. I think Stephanie would say 95% of our soybeans go to the PNW, 70% of those go to China. That's how important that is. Okay, so we look at the forward curve on the basis. This comes from the company called Ag Census, which I referred to earlier. I'm going to show you this slide from last November and then today, because this is what drives our bases in this market. So this is November looking forward from November for every month forward. So this goes out here, this is March, April, May. So this green line is the Brazilian basis. Okay, so back in November, December, it was about $1.20, $1.30 over. Harvest time is going to about 50 over. So this yellow line is the US Gulf basis, and this is the basis at the PNW at that time. So you'll notice here from November to December, there's substantial downward pressure on the basis in Brazil, which ultimately puts downward pressure on the basis in the United States. Here's the same calculation yesterday, okay? So take a look at how this has changed. So this green line is Brazil. So nearby, now remember, they're in the gut of harvest right now. Well, they're more than gut. They're 85 or 90% done harvesting. So the gauchos that got soybeans coming out of their ears, they got trucks standing in line, and they got everybody on strike. You know, so the basis is very depressed right now. And looking 3, 4, or 5 months forward, which puts them into July, August, you can see that their basis increases very rapidly. And this blue line is our Gulf basis, and this is our PNW basis. Go ahead, Frank. All right. All right, so this has changed quite sharply as we look at a post-harvest competition for Brazil. And you can see that we're mostly competitive with Brazil as we're 5 to 6 months out, where our basis values end up being lower relative to Brazil. Now, it's not a perfect comparison because this doesn't include the effects of ocean shipping. Another source of data, let me just show it to you. I don't know if you can get this or not. This is from a company called McDonald Bell's, the largest export brokerage company in the world. They're good friends of mine and ours, I guess. And they help us teach our NCI programs as well. But they put out a sheet every day on FOB export values. And you can see their values. This was from yesterday. Their values for, this is FOB. See, these are PNW values. Now notice they're projecting a FOB forward values in the area of 110 to 115. Remember the slide I showed you from ADM, they don't have a bid until you get till October. It's pretty interesting. So we use those a lot for calculations. So look at this calculation here. So this is, I call it international arbitrage. This is the price delivered China as of yesterday. From the US Gulf, this would be the basis value. And then this is ocean shipping costs in dollars per metric ton. This is the total price delivered in basis value terms to China. This would be their flat price level. Here's the same calculation for PNW in Brazil. So yesterday, for spot market, we're out of the market by about $4 or $5 a ton. I'm sorry, we're out of the market by about $6 a ton. US Gulf is out of the market by about $10 a ton. Now this is really important just for the practicality of competition. China's going to buy where they can buy the cheapest. They're very smart buyers, don't question that at all. But also under phase 1 agreement, which we're going to have to choke on for a while, one of the terms of that is China will buy at market competitive prices, okay? So my interpretation is this is market competitive prices, and China is not buying from the United States. Now, if we look forward on the bottom chart down here, here's the same calculation for every month going forward. Same exact calculation. Futures plus FOB basis plus ocean shipping. So now what you see here on the right-hand side, I have the Brazilian advantage. So they have an advantage to the cheapest US origin up until August. But from September, October, November, the US has an advantage. And during those time periods, the PNW has an advantage relative to the US Gulf. So that's really important. And as you read the market commentary today, now I'm not certain, other than traders, they look at this type of detail, they'll say, well, Brazil's not buying, but they might buy a new crop. I think that's what we hear. Well, this is, I think, what the conclusion is, comes out of this, and the logic for it is that we're not competitive with Brazil until we get to September. And in September, the PNW's the most advantageous origin in the United States. And our advantage is $1 to $3 a ton. Now, this excludes quality differentials, which is a complete another topic I'm not going to introduce, but it's an issue we have to address in this part of the country. Okay, so one of the issues in this particular year is the rate of China the rate of China purchases. Excuse me. So I keep track of this in quite a bit of detail. So on the left-hand side, this is by month from September going into July of 2021. And I show their demands. So their demands on average, you can think are about 7 or 8 million tons a month. And then this column right here is the amount of purchases they've made to date. You see that? And then the next column, yet to buy, that's how much they have left to buy. And then this right-hand side is their coverage ratio. Just like you as farmers, Frank's going to tell you about this tomorrow, you're 80% covered or you're 40% covered. This is China's coverage ratio. So they're 100% covered through April, okay? 97% covered for May. And then in June, July, it decreases. They're only 17% covered for August. Now, why do you suppose they're like that? Remember, don't question. The buyers in China are as smart as anybody in this country. They took our classes, so. I'm sure they're looking at these basis values. I'm sure they're looking at the tail end of the Brazilian crop and some logistical problems. So they don't want to buy for August in Brazil. And they're looking at 2018, 2019 crop and storage in the United States and potentially a larger crop in 2020. They're looking all at that. And then they're looking at my slides and saying, the basis in August and September falls to critically low levels. I'm going to wait until I buy during those gut periods. So they're not covered in August very well. As we look at, I don't have those intervening months, but as we look into February 2021, you can see they're like 20% covered. That's looking at just about the beginning of Brazilian new crop. So there's a period of time here, really from about maybe August until about February, where they have a lot of purchasing to make. And they're going to evaluate, I'm sure, how much to buy from Brazil, how much to buy from the United States. And I'm sure it's going to be driven by those delivered values to China, as in the previous chart that I showed you. There'll be political pressures. And I'm sure if they go for months without some notable buying from the United States, they're going to have some conversations by Trump, I suppose. But you know, these are kind of the way we look at the market this year. Okay, so for you as growers, I just urge you, you know, you're going to have a lot of difficulty in your careers trying to out-project the futures markets, but the basis market is very important. The basis market is more easily understandable, more easily controllable. The seasonal characterization of basis is very important, particularly in soybeans, particularly in this part of the country. Frank will speak about how you build that into contracts tomorrow. So looking today, and this is my last slide, so you can be thinking of questions now. Here's kind of my interpretation, looking at old crop. Though Frank told me you've already sold old crops, so don't worry about it. But I'm using it for educational purposes. And then looking at new crop. So as we look at in the past, from today going backwards, we have all of the commotion around the China trade deal and all of this. And if you went back a year ago, right now, we would be talking about flooding of the US Gulf, and closing of the barge ways. And we'd be talking about rail velocity. And then we'd be talking about Brazilian harvest and the lower bases in Brazil. And then we'd be talking that the basis normally declines from today, February, into July, August. Now, as we look into new crop 2020, this is the right-hand side of my chart, I would say the items of interest and importance is Chinese trade resumption. So this is very critical. I've highlighted how much they bought, how much they have left to buy. Technically, the tariffs went off in February. Technically, they went off for non-commercial purpose for buyers, but the non-government buyers still have to get a permit or a waiver of the restriction, but I'm sure they're offering those fluidly. That's an issue of their government buying versus private buying. So this Brazilian logistics is pretty important. I want to just elaborate on this. We're doing a project on this right now, so I'm pretty familiar with it. Historically, Brazil has always had logistical problems. So in my normal Brazilian speech, I'd be showing you a chart that shows the amount of time that vessels wait to be loaded in Brazil. And historically, during the harvest period, vessels would be waiting 20 to 30 days at $10,000 a day to be loaded. Okay, so that gave a huge advantage from the United States. But I think you have to be aware longer term as competitors that Brazil's spending a lot of money, some of the Chinese money, to expand their logistical system, and their average wait time, I have a chart of this if you want to send me a note, their average wait time has fallen from about 25 days to about 5 days on average. Okay, so it's not as good as us, but it's getting better substantially. This particular year, in the past couple of weeks, you start reading a lot of commentary about this mismatch of topics called congestion at port, ships waiting, trucker strikes, and COVID something, whatever that means. But taken together, what it's done is created some uncertainty about shippers being able to load in an expeditious way for shipments out of Brazil in the spot months. So there's been some gibberish about shifting from Brazil to the US PNW because of more reliable loading, less uncertainty about loading time, and shorter transit time to China. Now, whether this is a temporary phenomena or if it's a phenomena that will play out through the rest of the year, we don't know. The Brazilians are saying in April, they're gonna have record exports at 13 million metric tons, which will be the largest that China's ever bought and the largest Brazil's ever shipped during April of this year. Nevertheless, there's some gibberish about shifting small amounts to P&W to supplement this. As we look into August, September, one of the concerns I have, excuse me, is we potentially have 2 crops being marketed at one time in the United States. Frayne will speak more about that. But as we look into August, September of this coming year, just remember the basis normally weakens from 20 to 50 cents as we go into August. From today, declining 20 to 50 cents. There's little chance the basis is going to be increasing between now and August. So there's going to be downward pressure driven by Brazil exports, driven by coverage of the importers and all this. So downward pressure on the basis into August. As we look in the period of time beyond August, a couple of points that I think are really important for you. Number one, in the futures markets I've already showed you, it's a very narrow spread between August, September, and November, like 3 cents. So that says don't store. What the market's wanting and anticipating is everybody's going to be selling at harvest or near post-harvest period of time. So they're trying to discourage it. So the only potential gain in that post-harvest period would be that appreciation in the basis. We don't know how much it's going to go up. My expectation based on the past 2 or 3 crop years is we can easily see a 50 to 70 cent increase in the basis from August to about November, December, January. So probably taken together that says, look for a falling basis for new crop as we get forward here. Look for a crashing of the bases into August, a narrowing of the bases as we go into the post-harvest period to encourage a quick liquidation as we get into November, December. Frayne will speak more on that in a broader marketing strategy perspective. So I'm going to take a minute and get a drink of water, and I'm all done with my presentation now, but I'd be happy to try to elaborate on any of these points or answer questions if you have it. So take 2 minutes, I'll be right back. Okay, so you can either type your questions into the chat box or you can speak out loud to me and I'll try to answer them the best I can. First question is, how do you know when China is at 100% covered for each month? When they dip into the reserves, does that mean they are covered? So the question of reserves, I can't answer that so much myself. Part of the reserve issue is, they want to carry a stockpile of grain and soybeans. Historically, they just carry stockpiles of wheat, corn, and rice. They didn't stockpile soybeans so much. And they do that for strategic purposes because all those people got killed during the drought of whenever that was. However, I think in light of this COVID-19 business, they will be revisiting, like a lot of countries will, about their reserve strategy. Soybeans is a little peculiar, I think, because of the quality preservation aspects in a reserve. Unlike corn and wheat, I don't think it holds its storability as well. Fortunately, northern tier soybeans store better for them. But to the first part of your question, so the point I'm making, I can't really judge about this dipping into the reserves, because I don't know if they dip into the reserves, if that's for reasons of quality or for strategic reasons. I don't know that answer. But the first part of the question, how do you know when China's 100% covered? That's not easy. I keep track, and I use the data I showed you from is from Thomson Reuters. So every month, the Chinese Customs Department releases how much they have imported. And so we know historically what their import demand is. As I and that's that table I showed you. That's about 7 or 8 million tons a month is their import demand. So translate that, that's 96 million tons a year. And so the normally consumption nowadays is around 89. So that's about 7 or 8 million tons. So we know in the United States how much we have exported to China, because USDA every week publishes export sales by country and export shipments. So we know how much we've exported. We're the only country in the world that does that. Brazil only shows that monthly. But China, the data I showed you is the China from the Chinese Customs Department that is reported in Thomson Reuters. So that's how I keep track of that. And I guess, unfortunately, it's kind of painful keeping track of all of this. In my case, what I do is pretty important. That's why I do that. So I hope that answers your question.
Another one.
Okay.
Trade with China. Go ahead.
So, yeah.
You want to repeat the question?
So the question is, if trade with China ramps up next year, how quick will the secondary rail market prices weaken our bases at elevator this region? Okay, so I think you're kind of grasping my point. The overall logic here, and then I'll answer your question, is velocity has an impact on secondary market value. Secondary market value impacts the bases at Portland. The Portland bases affects the origin bases. We know that the correlation between the secondary market, there's a correlation to the origin bases and the export bases. There's a very delicate relationship there shown in my chart that I showed you. And it's obvious that if China imports go up, the bases at P&W will go up, the secondary market value will go up, the bases at the origin will go down. How much? We have that projection. The export bases will go up more than the interior bases. More than the interior bases will go down. But it's a very, very delicate relationship. And just another point that's important this year is that if the export basis goes up too much, as I showed you, we will become uncompetitive. You know, that value I was using in that calculation was 115. You know, and if the basis went back to normal at 150, we would be uncompetitive with Brazil. So the export basis can't go up too much. So there's a very, very delicate relationship there. So what does that mean for you as growers? I mean, at the end of the day, you have grain to sell. You have soybeans you got to sell. The way I look at it right now, the secondary market values are negative or zero. That's very attractive from a shipper perspective. And, you know, I envision a time in the future where smart farmers who are marketing may want to be haggling at this point right now about secondary freight with their export elevators. Don't tell them I told you this, but, you know, if you're a big farmer and you go to a big elevator and say, look, I know the secondary freight is minus $100 right now. I want to lock in my bases right now on that cheap secondary market. And they might not like doing that or might not like talking about that, but you know, you're at risk that if that secondary market goes up from minus 100 to plus 2,000, just use that as a potential that could happen. You know, your interior basis is going to go down sharply if your elevator is not covered. Now, if your elevator is covered in the primary market, there should be no problem. I think the problem we've had in the past is many of the elevators weren't covered. So the secondary market goes up to 2,000, they're short freight, they take it out of the bases. So I envision a time in the period in the future where you might have to be talking about freight at the same time you're talking about bases at this time of the year looking at new crop. Frank can talk more on that tomorrow.
Thanks. There's another question.
Yes, sir.
So what time frame?
Okay, what time frame specifically on new crop soybeans would you lock in bases on what you know now? So, you know, we're guys like Frank and I are pretty loose. We say new crop. Well, that's anytime between August and November. So I'd probably be pretty obnoxious if I just said sometime between August and November. Here's what I can tell you. We know the basis is going to fall as we get into August, July, August, September. We know that's going to happen. We know after August, September, the basis is going to be increasing. So one of the things you want to be avoiding doing is selling spot soybeans in August. That's one thing for sure. Or I say August, but really the answer is when harvest is about 6% done. That'll be the low of the basis for the crop year. And your question is what time would you lock in a basis for new crop? I would be shopping around for that November, December, January period, because that's when the peaks will occur, probably at 50 to 70 cents higher than the seasonal lows. And you got a little storage capacity there. So be looking at the November, December, January period, looking for a peak to lock in that new crop sales. That would be my answer. Frayne, I'll just make a note for him to speak more of that tomorrow. Is there other questions? You can speak to your microphone as well if you like. Any? Frayne, do you have anything that I should elaborate on? Okay, so then I will sign off. If you get the PowerPoint, if you get further questions, you can send me a note or send it through Stephanie. Or tomorrow I'll be here with Frayne, but he's going to talk about tying this all together in a marketing strategy. I'll make it to Frayne here if you want to make any closing comments and set them up for tomorrow.
All right, thank you, Bill. So I'm going to close out of Bill's slide deck here, and we'll be, so you can see me. Again, if you think of some questions for tomorrow, because I do have some presentation material I want to go through, kind of set the stage for pulling some of the issues we talked about before on not only the supply demand conditions and what we see going forward, but also potentially on futures market, trying to incorporate a lot of the things that Bill talked about now in basis. So how do you wrap that together and try and put a plan for preferably marketing, obviously, new crop soybeans, but I know that there is some old crop. Bill was giving me a hard time about old crop soybeans. I know there's quite a bit of that out there left. So we'll try and address both of those. Be thinking about what your questions are. Again, our start time is about 8 o'clock tomorrow morning. The login procedure should be the same. Hopefully everybody's kind of figured out the technology now and being able to either unmute and ask a question or type into the chat box. So unless there's something for the greater good that we need to cover, I don't know, Stephanie, if you have any last minute things you want to mention right now, but I know we'll be signing on again tomorrow morning at about 8 o'clock. So with that, thank you very much for attending, and I hope you have a great day.
What are you doing in the stock market? You're driving that down too.